This screencast is going to look at Delicia International Inc., so DIL, and it's going to look at the area of customer profitability analysis. So the same as the previous screencast, if you haven't read through the question, I suggest pause the thing, read through it fully, and in particular make an attempt at the question firstly, because then you'll get the most benefit out of watching this screencast. So I always advise students, have a look at the requirements first. That will inform you before you read down through the question. So first one, part 1, you're asked a brief report to the management of DIL, which ultimately describes what CPA, customer profitability analysis, is about, and evaluates the benefits. So in particular, the point I'm getting at here, if this is an exam scenario, is one, that you have a professional report, because it's going to DIL's management team. It describes what CPA is, so it gives them an overview what the purpose of it is, how do you go about it, and then finally evaluates the benefits. So this is really, it's not a generic checklist here. I want you to read through the question and identify, look, where is this useful for DIL to apply. Next one is calculate the profit earned by DIL from both Shop Extra and quality stores. So clearly showing revenue earned and gross and operating profit margins. So that concept of margin is here again. And finally then evaluate the customer profitability profile and comment. So this is really the calculations, and this is then your strategic comments. So typically you might get 60% of the marks might go for calculations, but there will be between 30 and 40% for comments. And this is really the chance for students to have the opportunity to actually go and generate some marks by showing that they understand the principles and can use the numbers to make intelligent comments. So we go back up again. I'm assuming you've read through this and made an attempt at it. The essential background to this piece is that DIL, they make baby products. They initially started off serving the groceries and convenience stores, so very much the smaller scale, and they've now moved up to the large supermarket multiples. But Ruth, who's your management accountant, is ultimately worried that the profitability of such supermarket multiples is deteriorating because of the cost to serve, i.e. discounts, the support services and whatnot. So again, linking to your part 1, which again we won't cover here, you'll see some points in the suggested solution, is, well, that clearly makes a benefit of undertaking customer profitability analysis. 1, you have clear customer segments, be it convenience stores, grocery stores, or supermarket multiples. And 2, there's a clear differential based on Ruth's comments about the cost to serve, and it would be useful insight using CPA to understand which is your most profitable segment to inform decision making. As I said, you can see more of that in the suggested solution. The focus here really is on the calculated part and drawing conclusions from same. So first part in any customer profitability analysis is, look, we need to understand what's the revenue from each customer base. Then we'll move on to the costs. So you're already told here revenue from Shop Extra is 18 million and revenue from quality stores is 12 million. And you're given in these proportions, 40%, 15, 13, 15. The first protocol is split out the revenue because each of those has a different gross profit margin, i.e. how much gross profit you're making on each product line. So we'll separate out then. First we look at Shop Extra. They're looking at nappies, skincare, milk products and solid products. And in the proportion we look at is 40%, 15%, 30% and 15%. So you already know that the total sales is 18 million for Shop Extra, and now you just allocate it out to nappies. So it's the 18 million times 40%. Same for each of the skincare, milks and solids. So all you're doing so far is really to figure out, well, what's the split of the revenue, because each of those revenue streams has a different gross profit margin. And you'll note that if you sum them up, the total revenue still comes to your 18. We've now just split it over the different products. Okay. Likewise, we want to figure out what's the gross margin. So in terms of direct costs based on this, what's the gross margin you're making in each of them? And we're told in percentage terms you're making 70% on nappies, so fairly profitable, 35% on skincare, 60% on milk products, and 40% on solids. So we can look at gross profit for Shop Extra will be, well, you're making 7.2 million sales of nappies and you're making a gross margin on that of 70%. So it means you're making 5 million gross profit on your nappy sales to Extra, and same logic across the board. So here it would be 2.7 million times 40%. And we sum that up, and it means, well, we're making revenue of 18 million, we're making gross profit of 10,305,000. And it's useful then just to get, well, what's the gross margin? Because remember, in your question, you're asked for gross and operating profit margins. So remember, margin is your profit over your revenue, and markup is your profit over your cost. So in this case, it will be 10 million over 18 million, which gets you to about 57%. Now note that's somewhat of a weighted average of all these percentages, some higher, some lower, depending on the weight of sale you've made. Okay, so that's the first part, is getting down to the gross profit line based on what the sales mix is of the products to this customer. However, you'll note for quality stores, which we'll just copy down and we'll change the numbers, is a slightly different sales mix. So this is quality stores. So in this case they have 25% nappies, 20% of skincare, 25% of milk, and 30% of solids. And their total revenue is not 18 million, it is actually 12 million. So I'm conscious that I will be going slightly quicker than you may be going when you're doing with a pen and paper, but it's just to show you the logic that it's the same mechanics as up here. So you can pause it and make sure you try yourself, and then you will just drag this down here. So you're using 12 million to allocate out. So nappies is 3 million, skincare 2.4, milk 3 million, and solids 3.6. And you'll note that they still have the same margin. With the same margin, the same products, you're charging the same margin for each of them, they just have a different sales mix. So quality store actually has only a 52% gross margin. And if the good students, when they're making their commentary, will go back, will link back, well, why is there a 5% gross margin difference? Well, the fact is that Extra sells 40% of the highest margin product, whereas you only sell 25. Yet the lowest margin product is 35 and 40, you sell a lot more of that in quality stores. So again, just depending on the type of customer, they will have a different profile of what they purchase. So that's essentially your revenue stream already complete. You know you have 18 million from Shop Extra, 12 million from Quality Store, and you know 10 million gross profit and 6 million gross profit. So that's complete. Now what you want to move on to is, the next part is the costs. Okay, so this question will be slightly different structure than you might have seen in, for example, the ITSL question, in that the ABC workings are already done for you and they're mixed in between the paragraphs given. So you now have to just track what's the relevant cost for each company, or each customer, should I say. So the first thing we're going to look at now is the marketing managers. So we look at the marketing managers, and we look at Extra, and we look at Quality. Just look at them separately. So DIL employs 6 specialist marketing managers to foster deeper relationships. 3 work for Extra and 3 work for Quality Store. Each is paid a basic annual salary of 70,000. So straight away we know salaries is equal to 3 times 70,000 for Quality, for Extra, and also 3 times 70,000 for Quality. Right. So 210,000 in marketing manager salaries. And we're also told a bonus which equates to 10% of the sales revenue generated from the multiple in excess of the target. So this question was actually part of a continuous assessment from prior years, so it's a small bit calculated than you might expect in the exam, but it's a good test of, do you understand how the bonus works and how to follow it. So if students go back up here, you'll note that you're told 18 million and it's 2% ahead of target. So again, you always have to ask yourself, why am I told this? Well, you're told this because that's what the bonus is worked on. So if we go back here, revenue is 18 million for Extra. Therefore the base, if 18 million is 2% ahead of target, the base must have been 18 million divided by 1.02, because 18 million must be 102%. Therefore your base was about 17.6 million, and the excess is 1 minus the other, which in this case is 352,000. And the bonus is based on 10% of that, so the bonus is actually 35,000 for extra managers. And the exact same logic will apply for quality as well. 12 million was the actual revenue. That is 5% ahead of target. So if it's 12 million is 5%, it must be 105%. To divide by 1.05, that means the base was actually 11.4 million. The excess over the target, which they're getting based on, is about 571 million. So they're well ahead of target, and they will get 10% of that, which is 0.1. Okay. So now you've actually made the calculations. We'll move down this one, and we'll say the total manager's cost is 245,000. Apologies, and I'm actually making a mistake myself. This bonus is for each of the managers. So each manager gets a bonus of 10%. So we have to multiply this by actually 3 as well. So 3 managers and 3 managers. So again, as I said, this may be a bit more calculative or granular than you might expect in the exam, because this was a continuous assessment and it was group work. But again, it's important to understand that if information is given in the question, such as 2% ahead of target, you need to watch out and ask yourself, look, why is that there? There will rarely be a red herring that's just to throw students. It's going to be used somewhere in the question. And it's useful to understand how a bonus scheme may be actually constructed. So the costs here are 315,000 and 381,000. So they are 2 costs that you will be taking to your final calculation. So the next calculation we're going to look at is general marketing salary. So again, we've worked on this paragraph. You see each paragraph will have different costs. So marketing managers is here. Now general marketing salary. We're told the allocation of general marketing, sales, marketing costs, excluding 6 managers above, is driven by hours spent. So essentially they've used their ABC system and they've said, look, the cost driver here for this cost base of general marketing salaries is the hours spent by employees at outlets. So typically 10 hours of time was spent by each employee at Extra every week, compared to 13 hours for each quality store. And in the case of quality, it was 2 visits of 6 hours each, whereas the DIL employee for Extra had just 1 long 10-hour spell for each visit. And the ABC system, so remember you have cost driver and also the cost. It says for every hour used, it's €35. So again, different to ITSL, you've actually given the cost drivers here in the cost, so you don't have to work that out. What you do have to work out, well, how many hours are spent in each one. So hours at outlets. So you know per week. In Extra they spend 10 hours per week, and in quality they spend 13. So weeks per year then, because it's an annual. So this is where again maybe a bit more calculative than you might expect in an exam, because this was a CA, but nonetheless it is useful to get this mentality to make sure you're comfortable with how to interpret information. 52 weeks in the year and 52 here. So the total hours spent in Extra over the year was 520 per outlet, and it was 676 per outlet. So again, that's important, as that is hours per outlet. Because you remember, there's more than one outlet. So if we go back up to the question, again, always ask yourself, why am I told this information? There's 140 outlets for Extra and only 50 outlets for quality. So now you have to say outlets 140 and 50. And then you say hours per year. So it's just 1 multiplied by the other and 1 multiplied by the other. So again, it's important, particularly in these questions, that you can appreciate that there's a bit more reading involved. You need to pay attention to how it's structured, because otherwise you may miss a vital component. For example, only taking this 520, you drastically underestimate the cost because you forgot that there was actually more than one outlet. There was 140 outlets. And finally then, we're going to look at the cost per hour based on our ABC system that's already done and it's given to us. A is 35. Therefore the total cost is 72,000 hours and 33,000 hours. So that gives us the general marketing cost that can be allocated to each customer. 2.5 million and 1.183 million. Another cost we have to do is travel. So you're told in the last part here, the travel cost is the average distance between DIL's premises in each of them is 55 and 35, and you call it 50 cents per kilometre for travel and subsistence. So again, for all the travel that these reps are doing, the marketing managers, you need to actually account for that as well. So again, we know the number of outlets already, and you're saying, well, how many visits per week, and then the number of weeks. So again, as I said, a bit more calculative than you might expect in an exam, but nonetheless useful for a benchmark. Number of outlets is 140 and 50. Visits per week 1, but you're told there's 2 visits per week here. And again, always ask, why am I told that information? It must be relevant for someone. And 2, and then the number of weeks is obviously 52. So the total visits to each extra store or each is 140 times 1 times 52. So you had 7,000 visits to extra stores in the year and 5,200 visits to quality stores. And based on that then, the average distance in return will be 110 here, 55 each way, and 70 here. So you just get the total distance, total travel. Again, I'm conscious I'm going a bit fast, but for the purposes here, a lot of this is mechanical, and then the cost is 50 cents each. So 728,000 kilometers, so 364,000, apologies, that should be 110, 55 each. 400,000 it's costing you, and 182,000 in travel expenses. So again, small bit granular in terms of the detail, but you need to be aware of why you told information and the ability to extract it. Moving on then, looking at there's a nappies cost as well, in terms of, you're told it's because it's a very bulky item, DIL want different incentives to ensure that the supermarket will hold it, because obviously the more stuff that they hold, it's taking up valuable shelf space, number one, and there's obviously a handling charge, security charge and whatnot as well. So DIL has agreed to meet the cost of installation and maintenance costs for shelving for Shop Extra, which equates to 7.5% of the value of the standard nappy revenue generated. So how much? 7.5% fee. So if we go up 0.075 times how much nappy revenue do we make from Extra? Well, we already know up here it's 7.2 million. So we split it out. So that means there's a 540,000 incentive fee there. So it's a costly one. But there's a separate fee here of a risk premium for the quality stores, and what the quality store agreement is, you're paying a monthly obsolescence risk premium of 20% of the sales value of nappies delivered in a month but not sold. So whatever's left, they want an obsolescence risk premium. So the typical value of nappy stock at the end of the month is 150,000. So whatever's left in stock at the end of the month, so that means every month there's 150,000 worth of stock. So that's been over the year, there would have been 12 of those, because you're paying a monthly fee, and that's times 20%. So 360,000 there. So again, relatively straightforward calculations. It's just to remember to read it and understand what it's actually trying to tell you. And the final one then, there's actually a financing cost. Well, there's 2 costs left. First is the financing cost. So you're told DIL offers 30 days credit. However, in 2011, Shop Extra took 40 days to pay its bills, whereas quality stores took 50 days. And because DIL operate a finely tuned working capital management strategy in terms of when they get pay the bills and when they get money in, it's going to cost them to use their overdraft 7% per annum. So for every day you're late, it's going to cost you a certain percentage based on 7% per annum to finance that. So for every day they're late, it's going to cost you extra money. So you should take account of that based on customer profitability analysis. So we'll first look at the revenue. So the revenue here is 18 million. And the revenue here is 12 million. Okay, so that's the first part. So you'll be dealing with a bit more of this in your finance module as well. So if it's 10 days late, well, what is 10 days worth of sales? So it's 18 million divided by 365 times 10. So that is about 493,000 worth of sales. And the cost of that is, well, if that's the amount that's always outstanding, they're always paying that late over the year, you're going to have to fund that at 7% of an overdraft. So it's going to cost you 7% because they're always paying 10 days late. It's going to cost you about 34 grand in interest from your overdraft to finance that. Same logic here. In fact, these are actually longer, that they pay 20 days late. So instead of paying 30 days, they pay 50 days. So this, what's 50 days worth of sales? Times 50. So about 1.6 million. And again, that's going to cost you 7%. So it's actually costing you, sorry, this should be 20, not 50. It's costing you 46,000 in terms of financing costs. Final thing you're told in is the admin cost is 20% of revenue, so plus 18 million times 0.2 and plus 12 million times 0.2. So once you have all that done, then you should do this. If you're doing this in an exam setting, do this in kind of an appendix and bring in, this is your customer profitability report. Then you will have extra here, and then you will have quality here. So what you want to show is revenue, gross profit, or gross, and then gross margin percentage, because you're asked for that in the question. And then you have a number of different costs that you want to put in, such as admin. You'll have the marketing managers, you'll have marketing staff, travel, nappies, and financing. And that will get you to an operating profit and an operating profit margin. So the point is here, and this is the principle of customer profitability analysis, you get the revenue first and then you trace the relevant costs. You didn't have to do activity-based costing because it was already done for you in the question here. Sometimes it will be, sometimes it won't. It will be dependent on the question. We know it's 18 million revenue, and we know it's 12 million revenue. Yeah. Gross profit, well, we've worked out up here. You're just going to drag it in. Gross profit here is 10 million, and the gross margin, gross profit on the quality was 6 million. And you can get the margin by putting one over the other. So this is just on the face of it for a final report. You want to make it look professional. The admin, we've already said, is down here, 3.6 million and 2.4 million. Marketing managers costs, so again, we're really just, all this has been done already. I'm just bringing it in, 315,000 and 318. Marketing staff, 2.5 million and 1.1. Nappies, 540,000 and 360,000. And finally, the financing costs is 34 and 46. Apologies, just after realizing I doubled up travel and nappies. So take travel out of there, put travel in a separate one, and that travel would be here, 400,000 and 182. So then to get the operating profit, it's your gross profit, 10 million, minus the sum of the directly traced expenses, which are all these, 2.8 million, and the same here, 1.62. And you're also asked for the operating profit margin, which is profit over revenue, and same for quality. So that is essentially part 2. Calculate the profit earned by each, which we've done, and show the revenue, yes, gross and operating profit margins. Yeah, we've done that. The final thing then is, as I said, and this is where important for students are able to distinguish themselves. A lot of students will get down to the calculations, but then be able to interpret that and comment. Well, first evaluate customer profitability profile. Now watch for this and. Whenever there's an and, you need to hit all the targets or you're not going to get the full marks. Comment on the potential strategic and financial implications for prioritizing supermarket multiples. So one of the first comments we've mentioned already is, well, relative for the two supermarket multiples, Extra is more profitable at a gross margin level, and again that is really coming back to the point we made before. This because the sales mix is more profitable because you sell a lot more of nappies into Extra. However, that 5% differential only falls to 2% at the operating profit level, still more profitable, but because it consumes relatively more overheads in terms of admin, marketing staff, that relative difference has fallen to only 2%. So that's first is to comment on between each of them. The other point is also then to comment, well, in comparison to your current customers of grocery and convenience, they have a gross margin of 50, so actually the margin on a gross profit level is more from the supermarket multiples. But when it falls down to the operating profit, which you're more worried about then, it's a lot higher. And that the good students will pick out that is more likely, that it's consistent with what Ruth has said, that the supermarkets are more intensive in terms of the resources used from overheads. So she said she was worried, and again, it's important for good students to pick this up. She's particularly worried that excessive service support and discounts, so such as here, may be provided to attract retailers and affect the profitability. So essentially that's reflected in the numbers. While gross margin are more profitable and an operating profit they're less profitable. And then in terms of strategic and financial implications, well, you can see the suggested points in the solutions when it's put up. But good students will point out, well, one, what's the strategy going forward in terms of, although grocery and convenience stores may be more profitable, there may be no growth potential there, and really you're going to have to put up with lower margins to get the relative scale by going to supermarket multiples. As well as that, you'll also look at, well, what about strategic in terms of activity-based management? Look at the main cost driving here. It's the people on the floor, people on the ground. 2 million and 1 million for people going out for store visits. Likewise with travel costs. Likewise with admin. The good students here will identify what is driving that admin. We're only told a very generic 20%. Let's dig down there and figure out what's driving that. Or do you need that many visits? Do we need that many man hours? Can we outsource some of that? So again, those are the strategic and financial implications, or looking at the cost to serve of the customers to see is there any levers we can do to improve profitability. And the best students then for looking at the real top marks will be bringing in concepts such as activity-based management to manage those costs more effectively. So that is DIL question covering customer profitability analysis.